All right, we're just getting set up for Be the Boss of Your Money. Let's take it to camera one. Welcome. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is a show about personal finance. Really, it's a show about helping you to take control of your money. Money means a lot of things to a lot of people. We have things to consider like our houses, our stocks, retiring, paying for college, the daily minutia of making money, spending money, bills. We've got a lot going on. Today, I want to talk to you about this huge turnaround, the big bounce in the NASDAQ, and I want to specifically to get into what I see as the most speculative part of the stock market today. And to me, I see lots of danger signs flashing and warning. So let's just roll the quick intro. We've got a lot to go over, and I want to get through it quick, and I want to give you value that you could take to the bank. Let's do it. Welcome to Be the Boss of Your Money. Thank you so much for joining me. Your time is precious, and I greatly appreciate that you chose to spend some of it with me. So here today, as always, I'm here to bring you value. I'm here to bring you a show. I call it Be the Boss of Your Money. It's about personal finance and so many things that fall underneath that umbrella. Investing, credit scores, estate planning, taxes, all of these things fall under that umbrella. But today I want to talk to you specifically about this huge turnaround after a 10% drop, a quick drop in the NASDAQ, which, by the way, that's how it usually happens, quickly. Okay, we saw how quickly the NASDAQ went up. It goes down even quicker when it does. And then we're going to get into SPAC, special purpose acquisition companies. What are they? What's the big fuss? And to me, this is just another version of the IPO market of the years 1999 and 2000. I see virtually no difference except that we're going with SPACs instead of IPOs. And I just want to give you some warnings because all you hear about is how great they are. Shaquille O'Neal is involved. Paul Ryan, former Speaker of the House, is involved. Other famous people have gotten into the SPAC space. But that doesn't mean it's for you. And you know something? You don't even know what you're buying when you buy a SPAC. That's the crazy thing. So let's just get into a couple of quick things, talk to you about what happened today in the market. If you have any questions, certainly ask me in the comments. That is my favorite part. When you have a question, you ask me in the comments. I give you my answer. We talk, we discuss. I love that part. If you're watching this in the replay, welcome to you as well. And if you're watching again in the replay, if you have a question, words of wisdom and words of encouragement are always appreciated here on Be the Boss of Your Money. Certainly ask me in the comments and I will see the notification. And I look forward to getting back to you as well. By the way, you can track me down. You can follow me on Instagram at InstaMitchG. You can catch me on LinkedIn. You may be watching me now on LinkedIn. Okay, Mitchell Goldberg, AIF. And you can always catch us, Client First Strategy, on Facebook, on YouTube. Let's take a quick view of exactly what's going on, because today is definitely a day that we could remember. I'm going to switch to camera 4, which is the computer screen. Put myself up here. All right, here I am, upper right-hand corner. You know what? I have my corner picture. Let's get to this one. Almost covers the bald spot. All right, there we go. That's better. All right, if you're out there and you're watching this, if you give me a reaction, I'll see who's out there. I'll see your name, and I'll be able to say hello. And it's also nice to know who's watching, and I would just love to see you out there. So let me know with a thumbs up or something, and I'll get to see who's out there. Don't be shy. If you have a question, you want to say hello, comments. If you want to let me know where, if you want to let me know where you're watching from, the comments. If you want any more information about this, you can certainly DM me or the comments. Okay. So let's just take a look. The Dow Jones, not a huge day for the Dow, up a measly 30 points. But the NASDAQ took it away, up close to 3.7%. This is the biggest day in the NASDAQ in about 4 or 5 months. This comes off a correction, a quick 10% correction. It's normal to see big spikes up after big spikes down. So as big as it is, it doesn't mean that we're necessarily out of the woods. It just simply is a battle that we've been talking about here on Be the Boss of Your Money between higher rates, high flyers go down, lower rates, high flyers go up. It's just that seesaw battle back and forth. David Tepper yesterday, famed, noted hedge fund manager, came out and said, you know what? He thinks interest rates have peaked and he thinks it's hard to be bearish. The market took its cue from him yesterday, sent a lot of stocks up. Most stocks yesterday still went down, but today we finally got the turnaround. So let's just get into a couple more things. Gold finally had a decent day, up 2%. Oil off a little bit, but oil's been on a big tear, so no one can complain. And here's the 10-year Treasury, down a couple of fractions, a couple of ticks, but still below 1.6% at 1.53%. It looks like 1.6% on the 10-year Treasury. It looks like 1.6% of the 10-year Treasury is the line that can't be crossed. When you get over 1.6%, that's basically the resistance level for the interest rates on the 10-year. And if we exceed that, then I say we have to find another readjustment, which is just another way of saying a painful time of discovery to see where stocks could settle. Okay, let's get rid of that tab. I've got a lot of tabs open. Let's get rid of that tab. We're going to get into those, but I don't want to just get into those just yet. Let's take a quick look at a couple of other things. Stay with me here, okay? We're going to just take a look at how the crypto market did today. Let's take a look at crypto. Let's take a look at the crypto market. Okay, so crypto had a good day today, by the way. Crypto is back, Bitcoin's back to above $1 trillion market for all the Bitcoin, $54,000 for Bitcoin now. So it's basically almost back to its former high. So a strong day for Bitcoin. Again, interest rates go down. The high flyers, your Zooms, your Pelotons, your DocuSigns, okay, the stocks that did well during the pandemic, and then crypto, Bitcoin, okay, is on steroids. They do very well when interest rates go down, okay? Just Bitcoin does it on steroids. So I hope that's a good analogy. All right, so let's talk about SPACs. That's the reason why, I got out of bed today to talk about SPACs. Andrew, I see you out there. Thank you for joining me, buddy. Thank you for one of those. I really appreciate that. Folks, if you're watching, let me know you're out there. Give it a like. Say hello in the comments. We want to talk about SPACs. And if you have any questions, words of wisdom, words of encouragement, they are appreciated. If you don't want to, then fine. It's okay. You're entitled to your privacy. I don't want to violate that. Just having fun here with all of you and learning something. So let's get into the learning. A SPAC is a special purpose acquisition company, okay? Back in the day when I got into the securities industry over 3 decades ago, these were called blind pools. That's basically what a SPAC is. It's a blind pool. And there's nothing to SPACs as far as operations, products sold. There's no revenues. There's no earnings. It's simply a company that goes public on one of the major exchanges. And when a company goes public, and when a company goes public, they raise money. So they go public, they raise the money, and what happens? Now, in the IPO process, which is a very stringent process, there's a lot of due diligence in initial public offerings. You generally want to see a company with a business plan and a forecast and reasons to go public, also outlining the risks. SPACs don't require as much due diligence. So they go public, they raise cash from investors, and that's all they have is the cash. Okay? They're not putting the cash to pay down debt of a company or to improve the operations of a company or to invest in new plants and equipment. So a special purpose acquisition company, some of them have funky names. They go public, they raise the money. What do they do with the money? Well, they typically have 2 years to acquire a private company. They acquire a private company or merge with a private company, either one. You could do either one. And then the private company, the owners of the SPAC exchange their SPAC shares, their shares of the stock, the SPAC, special purpose acquisition company, and they exchange it for shares of the new company. And that's how the new company goes public. So they bypass the stringent IPO process. Now you've got this private company that now is a public company. And if it sounds simple, I don't want to make it sound that simple. I don't want to oversimplify it, but it is a pretty simple process compared to the initial public offering, the IPO route. But here's the thing, like if you follow Peter Lynch, who is the famed Fidelity fund manager, okay? Peter Lynch, he ran Fidelity Magellan was the name of the fund he managed. He was like the very first super popular, well-known celebrity hedge fund mutual fund manager, I should say. And his advice was always, especially in his book, One Up on Wall Street, which I think continues to be a bestseller. Great book, by the way. He says, buy what you know. If you follow his advice, you wouldn't buy a SPAC because you're not buying what you know. I mean, you're giving money to a SPAC. It's managed by a person or a group of people who simply say, we're really good at finding private companies to buy, and we're going to just take the money and buy a private company. We don't know what company it is. We haven't found the company yet, but we're going to buy something. And if you don't do it in 2 years, we're going to give you your money back. And we're not going to have that opportunity of making a lot of money when we find an acquisition target and the stock goes up. Okay, so that's basically what the SPAC is. It's, to me, the most speculative part of the market because you really don't know what you're buying. The thing is, there have been a number of SPACs that have gone public. I think DraftKings is the most famous one. And they went public, a company called, a SPAC called Diamond Eagle Acquisition Corporation, bought the privately held or merged with the privately held DraftKings, swapped their shares for the new shares of the new merged company. Now it's DraftKings, and people saw how well that did, so they looked for another one and another one. So that's how that worked. Now, when I say SPACs, I'm not here to knock them. If you are a believer in SPACs, I'm not knocking you. I'm going to be naming some names. I'm going to be pointing out some SPACs. This is by no means is this a recommendation for or against a specific SPAC. I'm speaking in very broad categories, broad strokes here. Okay. So my opinion is people are playing with fire. And much like 1999 and 2000, we had a rash of IPOs. Some of them were pretty good. Started early. They started like 1995 with Netscape. But by the time you got to the end of the 90s and early 2000, the quality of the IPO'd companies was lower and lower and lower, to the point where you basically had very early developmental stage companies that had no business being publicly traded that were IPOing. They were getting listed on exchanges, and investors just automatically thought you get the IPO, it goes up a lot, you sell it. And unfortunately, the bubble burst and people were left, especially the newcomers, the Johnny-come-lately investors, were left holding a lot of worthless stock and really just brokenhearted. And I see that happening now. How many really good private equity companies, private companies generally, are good enough to go public? You're supposed to be really good, I think, when you go public. It's you're raising money from investors. You have to you should have something that's worthwhile. And if you are in a SPAC and the SPAC decides to buy a company that's not so great, it's not like an IPO where you could pass on it. It's like you already bought the SPAC and now you're just waiting for management to make the acquisition, to make the announcement, so you could get a quick hit and get out. And I think people are a little spoiled now, where everyone thinks that they're just going to make 40, 50, 60% on every stock they buy. And as you can see, a lot of stocks have come down a lot. Even after today's nice rally, you look at the Zooms, the Pelotons, the work from home, stay at home stocks. These stocks are nowhere near their former highs just because they had one good day. Tesla as well as another one. Okay, so let's take a look at some of the SPACs. All right, I'm up over here in the left-hand corner. Virgin Galactic was up to 62. You see this green line here? Let me see if I can make this a little bigger for your smartphone screen, okay? You see this 62.80 down to 9? It's 30. How many people do you think bought it under 30? Probably a lot of people became enthusiastic about it at a much higher price. Probably. Nikola, 93. It's almost at its low. So great for those who had the initial pop. But even if you were in the SPAC before Nikola became a publicly traded stock, if you were in the pre-IPO, let's say the pre-SPAC, if you were in the SPAC before it merged with Nikola, you wouldn't have known that. So the question is, how many SPACs could you buy? And when does the window shut for SPAC offerings? Because eventually investors wake up and they realize that so many of the SPACs that are merging with private companies, that the quality is so poor that more and more investors start walking away. The smart money will walk away first. Then there's just two pure SPACs. There's Churchill, which is a big one. Okay, as high as 65. It's just cash. They haven't done anything yet. Down to 24. And the heavyweight, this is Pershing Square. And a lot of people feel that this one has a better shot of anyone else, of any other SPAC to do well, because this is Bill Ackman's SPAC. And he's not taking any management fees if they don't do a deal. And that was up to 38.75. It's 35.78. It's holding up okay. But I think this is like the rare bird in the space. And even at that, it came public at 20. So they raised money at 20. It's not like they put the money into an operating business that makes it worth $35 or $36 a share. It's the cash at $20 a share. But people are in it because they don't want to miss out. So if Pershing Square announces they found a target, if you don't want to be in it late, you want to be in it early because you think it's going to rocket up even higher. But this is the heavyweight in the group. And Bill Ackman, I think, is I think he's doing the right thing by saying, look, if you don't make any acquisition, we're not taking any fees. And I think that's actually, generally speaking, I think that's a really good thing. Okay. And that's why Bill Ackman has a good reputation, by the way. But the others, like Church, not so fast. And there's a whole group. Muddy Waters is a short seller who's down on a lot of SPACs. But here's a list of shell companies or SPACs. Okay. And this just gives you a ton of them. Pershing Square, PSTH, that's the one we just looked at, and Churchill Capital, CCIV. And these are all the other, I don't know if it's every SPAC, but there are so many SPACs. The website is stockmarketmba.com. Okay, there's a list of SPACs, and some of these have weird names like Far Peak Acquisition Corp, Go Acquisition Corp, Sports Entertainment. I guess it's so weird. But who knows what they're going to do? Obviously, they're looking for something with sports. Silver Spike Acquisition, Altimeter Growth Corp, Health Assurance Acquisition, Horizon, Gores Holdings 5, So there's a big list that you can find, and most of these go public at $10 or $15 a share. And I think the reason that this group is so hot now is because interest rates have been so low for so long, and investors have made so much money in the stock market. So many stocks are up, and so many assets are so inflated that investors are just looking for the next thing to go into. But every new thing that comes out, you've got to swing for the fences harder and harder. And I feel like the new things that are coming out are more and more speculative, more and more dangerous. So that's my beat on the space. Is this the article I was looking for? Hey, moneymaker inside the SPAC bubble, $156 billion bubble. There have been close to 500 SPACs in the last year and a half. You've got to read this article. I shared it on LinkedIn, on my Facebook page, and on Instagram yesterday. Okay. Hey, moneymaker. A rap artist who's actually now is buying SPACs because he learned about them on Twitter. He's putting his money into SPACs, and he actually made a video about it, which I guess is kind of fun. Maybe he'll get some notoriety and some hits and subscribers on YouTube, okay, on his video. But there have been over 400 SPACs, and a number of investment bankers who've been interviewed have basically said, like, of SPACs you're seeing now, they're like, we saw some of these acquisition targets a year ago or more, and we passed on that because they were so speculative. They were just basically not even a business plan. They were just like a pipe dream on a sheet of paper. So you should definitely take a look at this article. Okay. So that's my story. I'm sticking to it. What do you think, guys? Do you like SPACs? Are you interested in these? Do you think you bought the SPAC? Because everyone who buys a SPAC will say, well, my SPAC is unique. And I see the SPAC sponsors come out and say, well, ours is unique because of X, Y, and Z reasons. Everyone says their SPAC is a great one. The SPAC sponsors typically collect fees on the money while the money is being held on the money that they raise for an acquisition, and they get 20% of the final deal. Now, here's the thing I want you to really pay attention to. I see a big conflict of interest in the SPAC business model. These SPAC managers, and there's over 400 SPACs that have come out. So you can't tell me that all of these managers every one of them has a great reputation. There are a few out there that may have great reputations and great track records. But you can't tell me that every one of them has a great track record. But if you're a manager of the SPAC, you are incentivized to do a deal, because if you don't, you lose out on fees. You may even have to give fees back that you collected on the SPAC for the 2-year holding period. But most importantly, they have to give up 20% of whatever acquisition they could have bought. So by the end of the 2-year period, I think you're going to see a lot of these SPACs run out of time and just buy anything just to get a deal done, because that's how they make money. Now, right now, you're talking March of 2021 while I make this video, okay? It's March 9th. So you've got to believe between January and March of 2023, you're going to have an awful lot of SPAC sponsors, managers who are faced with the problem of having to give back the money to investors. A lot of them are going to be faced with the problem of having to give money back to investors and losing out on a lot of fees and a lot of deal stock. That is an incentive that I don't think works in your best interest. Incentives in my industry should work like this. The more time you have, the better the incentive. Not the less time you have, the better of an incentive, because I feel it pressures people to do things that they ordinarily wouldn't have had because they're so incentivized to do that. Nobody raises money in a SPAC to not get a deal to completion in 2 years. Nobody says, well, we'll buy a SPAC. We're probably not going to do anything. No, they buy a SPAC and they have to, convey confidence and say, our goal is to find an acquisition target over the next 2 years. And 2 years, by the way, it goes by like that. So my feeling is that as these companies get closer and closer to the 2-year drop off, you're going to start seeing a lot of crappy deals. And I think that these things are super speculative as a result. You've probably seen the best deals already. You've probably seen the best companies come out by now. And every time new deals come out, every time SPACs find an acquisition target, they're having to pick lower and lower quality ones because the quality ones are discovered. They're not in hiding. They are found, they're acquired, and then the remaining SPACs have to go find what's next, and then what's next, and then what's next, and so on and so on. So that's my story, all right, on SPACs. And this is why I think if you're just want to throw money into a blind pool, you buy a SPAC. I know SPACs have been hot lately, but I think it's a fad. To me, I've seen this movie before in the year 2000. I saw how it ended, and it ended really, really bad. And just because some famous person, a famous basketball player or a famous football player or a famous rap artist is getting involved with a SPAC, that means nothing. This is still about mathematics and patience. That's what investing is about. And celebrity endorsements mean absolutely nothing in this case. Not to me anyway. Andrew is out there. Have to find a good sponsor with a track record. Look, there are good sponsors out there. This is why I said I'm speaking in broad terms. Like I think what Ackman has done is a good thing, the way he went about it. But how many Ackmans are there? Now I know there's Chamath. I'm trying to have it written down. Pali Hapitia, and I apologize if I mispronounced his name. Like he's becoming pretty popular, I feel like, with the younger set of investors, the Robin Hoodies. And here I get to see it now. Somebody's, oh, you're knocking Robin Hoodies? You're knocking us? I'm not knocking you. I've done so many videos and so much content about Robinhood and respect Robinhood and respect other people. You can't say for a second I'm disrespecting anybody. Okay. I am so pro investor. I am so pro do it yourself. It's unbelievable. It's just not even going to get into it. Well, I guess I already did, but I think he's also popular with the younger set because he's got a good track record because it's been a hot market for SPACs. It's also been a hot market for the NASDAQ for like the last year. These things aren't hot in a bubble. They're hot because the market's up. As John Kenneth Galbraith once said, don't mistake genius for a bull market, right? But I could see it being popular with the younger set because the younger set are new to the market and they haven't seen what I've seen. Look, the NASDAQ, the tech wreck was 21 years ago. Exactly to this month was the peak of the dot-com era, March of 2000. And if you're 35 years old right now, you were in 9th grade when that happened. You didn't feel it. You could study it. Like, look, I've studied the Great Depression. I've studied bear markets, but I've lived through a few also. And until you live through a bear market, when you read about it in a short amount of time, but these things go on for years. And that's why I think Chamath or Kamath, I'm not sure how to pronounce it, but I think one of the reasons why he's so popular with the younger set is because the younger set looks to him for leadership and they haven't been led down the wrong road. They were very popular fund managers and hedge funders back in 99 and 2000 also, and people revered them. They looked up to them. I remember the Munder Net Fund. And they all got their comeuppance. They all eventually succumb to what we all know is going to happen. So be very careful, buyer beware. if the SPAC market, if SPACs are for you, just know that this is, I feel, for the speculative portion of your assets. It's very tough to pick which one is going to work because you have no idea which one is going to work. It's just throwing darts at them because they just invested cash. They say they're going to buy a private company or merge with a private company, but you don't know it. It's at the sole discretion of the management of the SPACs. Janus comes to mind. Yeah, remember the Janus 2020 fund? The Janus 20, rather, not 2020. The Janus 20 fund. You know, that was just like such a great fund. And the Van Kampen Emerging Growth Fund, right? Remember that one? I mean, they're all invested in the same hot stocks of the late 90s, early 2000s. People thought they discovered something, and there were metrics like eyeballs. And if you knocked these companies or said they were overvalued, people would say to you, we get defensive and say, oh, what do you know? You're stuck in the old world of economics. You're like, this is like, you know, valuation. Valuation has changed. It doesn't mean anything anymore. That's what you think. Well, guess what? Valuation came back with a vengeance, and it wiped a lot of people out. It took a long time to get back to a speculative froth in something like SPACs. It took 21 years, but we're finally here. That's a generation, 21 years. So, of course, every generation has to learn on their own. Yes, the madness of crowds. Jay, on that note, I'm going to leave it here. Okay. I hope this is helpful. I thought I would be a lot more exciting when I spoke about SPACs, but I guess maybe I'm just a little too analytical. I know too much about this stuff. I have so many things in my head that I want to get out into the live stream. I want it to be complete. But that's it. I'll see you tomorrow. Thank you so much for watching. Bye.